years down the line that will continue to hurt the profitability of some of the carriers. Insider selling has been extreme in the market lately, and the preponderance of insider action has been on the sell side for some time now. That is usually a pretty good tip-off that the people who own the companies and run the companies feel that their stocks are going to move lower. They're usually in a better position to know the situation than people on the outside looking in. It appears that the market at the current time does also have a tremendous lack of volume, which means the amount of liquidity going into the market. And with the bond rate now at above 8.5%, the government bonds seem to be a very attractive vehicle for investors, and that may also drain money from the stock market. I believe the market's going to sell off from here, and that the little rally that we're having now is nothing more but that, a little rally, not the beginning of a new bull market. My numbers are on the screen, and if you believe, as I do, that we are in an overbought condition on many stocks and would like to participate in the downside, I suggest that you call me. My numbers are on the screen, 213-316-5181 and 800-562-8555. And yes, even the stock brokerage firms are going to suffer as volume shrinks. Naturally, stock brokerage firms make their living off of higher volume, and as volume is continuing to be weak, I also think that certain brokerage firms can be sold short or liquidated out of your portfolio as appropriate. I'll be back again on Friday at 5 to 7 in the morning. Thanks for listening. And once again, if you're interested in short selling, I'm happy to talk with you about it and, in fact, discuss your entire portfolio. Thank you again.
This has been The Frequent Trader, brought to you by Thomas F. White and Company. The preceding was a paid commercial program.
Commodities, are they right for you? Successful commodity trading is possible if you know how. That's where Rochelle Atlas Mays and Bruce Eisen come in. They're experts in the world of commodities.
Talking about possibly interest rates going up and a stronger dollar.
And they're here on the Business Channel, charting market trends and targeting investment opportunities.
This is a very good option, in our opinion, to be purchasing at this time.
Join them for their commodity wrap-up, Tomorrow's Futures Today, weekdays at 12:45, exclusively on the Business Channel.
Good morning, everyone. We have a nice rally for you this morning to start off your day. Dow Industrial is up 22 points. In the headlines this hour, new fees at Merrill Lynch. And 2 states are going after TRW. That is the credit rating agency that you may have some gripes about, too. Well, let's take a look at the numbers we have on Wall Street so far. We had Japan last night up 2.25%, about 600 points, and London was up 18, so that helped give our market a boost this morning. The Dow at 22.5 points now to the upside. Transports are up 11.99, almost 12 points. Utilities up 0.19. Tick is positive, and the volume 25 million shares traded. That's probably a little better than we've seen the last few days. This time in the morning, the American Exchange up 0.90, and the NASDAQ Composite is up 241. Yesterday, by the way, the Dow fell 14 points. On Monday, though, we were up 29, so as of the close yesterday, we were up 15 on the week. Bonds are up 2/32. No major news in this market. Bills are up 0.01. The bond yield, by the way, 8.52% last I checked. Gold is up $2 at $372.60. Crude oil up 8 cents a barrel. The dollar index is higher this morning by just a slight fraction. Well, Wall Street profits soared above $2 billion from January through June after a money-losing 1990. The 2 primary reasons for the securities industry's 6-month boom are a stock market rally and a flood of new corporate stock sales. Both, though, have tailed off recently. For that reason, analysts do not expect this year's second half to be nearly as successful. John Keefe, who is an industry analyst with Lipper Analytical Securities, says it seems the appetite on the part of investors has been sated. Nonetheless, the first half is expected to go down in the record books as the best 6 months since the first half of 1987. Well, 6 states have charged in lawsuits that TRW, the giant credit rating agency, violated consumer privacy and made mistakes that harmed credit ratings of thousands of customers. The plaintiffs allege that TRW sometimes combined the credit histories of people with similar names, even mixing up consumers in their 20s with those in their 70s, and that such inaccuracies are hard to correct. Well, as if Drexel Burnham Lambert didn't have enough trouble, a federal judge in Manhattan has ruled the Central Bank of Yugoslavia can sue under U.S. securities laws to recover $71 million it invested in Drexel. The central bank claims it was duped into turning the money over to the former junk bond specialist to invest in what it thought would be conservative securities. Instead, it claims Drexel used the money to try to avoid bankruptcy without success. Well, NBC and CBS are asking the Federal Communications Commission, the FCC, to reconsider its new rules, which block them from owning the shows that they air and selling them into rerun syndication. The networks have announced a joint petition appealing the FCC's revision in May of the financial interest and syndication rules, which are known better as FinCEN in the industry. Worldwide, the sale of reruns generates $5.5 billion a year, and they'd like to get in on that action. Well, the recording and consumer electronics industries are reportedly close to an agreement that would compensate record companies for copies made at home or on digital audio recorders. The New York Times says the proposed agreement is expected to be announced today, but final details still need to be wrapped up, and opposition from the electronics industry could scuttle the deal. The published report says that under the proposal, consumer electronics makers would pay royalties to the recording industry on the sale of their digital tape recorders and blank digital tapes. Well, let's have our first look at the morning actives, then we'll come back and talk about those new fees at Merrill Lynch.
Attention investors, here's a no-risk, try-it-for-free offer from Investors Daily you can't afford to pass up. If you call now, we'll send you Investors Daily for 2 weeks absolutely free. And with your free trial subscription, we'll also send you a free 1-hour audio cassette guide to Investors Daily, recorded by William O'Neill. Call 1-800-262-7757. That's 1-800-262-7757. Please call now. That number, once again, is 1-800-262-7757.
Well, if you're a person who likes to hold your stock certificates at home or in a safety deposit box, you will probably not like this story at all, and it kind of looks like it could be a trend in the industry. Merrill Lynch is going to charge investors $15 when they request a stock certificate beginning in late August. The charge also applies to bonds. The Wall Street Journal said that the stock certificate charge is part of a bundle of fee increases that Merrill will impose, and it continues a pattern of rising costs for small investors. For years, the securities industry has been phasing out certificates in favor of less costly computerized records, which show that what securities an owner owns. Well, Kellogg, responding to controversy surrounding the name of its Heartwise cereal, says that it is going to voluntarily rename the product. They'll be calling it FiberWise. It notes that current Food and Drug Administration policy discourages use of the term heart in brand names. Heartwise contains psyllium, which is a natural grain with more than 8 times the soluble fiber of oat bran. Federal agents are warning that counterfeit $20 bills are circulating in L.A., and new immigrants could be the special targets. Clint Howard of the Secret Service displayed some of the bogus bills in Los Angeles at a press conference yesterday. Authorities say about $467,000 worth of phony money, or funny money they call it, has turned up in the LA area since last August. Howard says that illegal aliens may have been used to circulate the money, and about 100 Mexican nationals have been arrested for possessing the bills. They also say that foreigners are subject to be abused with this because they may not be too familiar with the look of our currency. Well, business owners are welcoming a ruling that orders Bank of America to slash the amount it charges them to process bounced checks An Alameda County Superior Court judge said that B of A's current fee on $3 per bounced check is excessive. He ordered the bank to charge no more than $1.73 per check starting August 1st. The ruling came in a suit filed against the bank by the California Growers Association. It does not affect the $10 fee that bank charges customers whose check bounce. One other sign of the banking industry's troubles, Citicorp says today it may lay off as many as 17,000 people under its cost-cutting program, 10,000 more than previously announced. Citicorp's chairman, John Reed, made the announcement last week when talking to a group of summer interns, according to Bank Letter, which is an industry publication, but it was confirmed by a Citicorp spokesman yesterday. Well, that is the news we have so far this morning. 7 after 10, the Dow Industrials are up 20 points. I'm Maria DeLong. Stay with the Business Channel. Up next, we have a hotline call for you.
The best performing portfolios of the 90s will have a key new ingredient you need to know. The state of Virginia's retirement fund just added $100 million of this new element, and they're planning for up to $500 million more. It's not stocks, bonds, or real estate. It's managed futures accounts, the newest asset class. Whether you have a financial advisor or you make your own investment decisions, you need this book on adding managed futures to your portfolio. A $10 value free from the Investment Club. Dial 1-800-4MA-BOOK now. It's filled with charts, tables, mathematical formulas, and much, much more. During the last 10 years, managed futures investment volume has grown from $500 million to $20 billion and could top $50 billion by the end of the 90s. Most financial advisors agree that sooner or later, managed futures accounts will be in every portfolio. Get your free book now on adding managed futures to your portfolio. Call 1-800-4MA-BOOK.
Back again, let's have a look at commodity numbers this morning. Bonds are up 2/32. Bills up 0.01 and euro dollars up 0.01. Last I checked, the bond yield was 8.52%. Gold is up 180 this morning to 372.40. Silver up 3.7 cents at 451. Platinum is down 360 at 380. Copper down 1.1 cents and palladium is down 15 cents. The S&P 500 up 290 this morning. The Maxi up 405. The value line is up 210. We've got the market up 23 points. That's about the best level of the day. We opened higher this morning. The knife is up 160, so all your stock futures are nicely higher today. CRB index is down just a slight fraction, showing commodities prices on average are little change. The dollar is up 0.15. The mark down 0.13. The yen is up 0.0006. British pound down 0.82. Overnight, by the way, the Tokyo market was up 2.25%, about 600 points, and London was up 18 midday. The franc is down 0.14. Canadian dollar up 0.07. The Australian dollar is up 0.11. Crude oil is up 8 cents a barrel to $21.34. Gasoline is up 0.0051. Heating oil up 0.44. Natural gas is up 0.043. Coffee up 0.10. Sugar is down 0.24. Cocoa is down 0.03, and OJ, no reading on that. We'll have to find out what's wrong with that contract. Does not look correct to me at all. Well, in news relating to commodities this morning, the Forest Service has halted sales of live trees in the Sierra Nevada while officials review the effects of logging on the California spotted owl, a southern relative of a threatened species. The policy marks a major shift in the Forest Service approach to timber management, from a program that was once driven by timber production to one that gives more attention to the environment. That is according to a Forest Service spokesperson. Well, when is something worth less than the sum of its parts? When that something is a chicken, apparently. Chicken, very popular these days, the American diet. An Agriculture Department study says that whole broilers are becoming much less popular than cut-up chicken in the grocery freezer. The report said that by 1995, only 12% of the nation's broiler flock will be sold as whole birds. The study also says that with today's two-income families, many people just do not have time to cut up chicken for home cooking. The discovery of black widow spiders in California grapes sent to the east is prompting two supermarket chains to stop selling those grapes. Hannaford Brothers stopped selling grapes on Monday, shipped by a trucking company from Southern California's Coachella Valley. That occurred after two black widow spiders were found in packing crates at a distribution center. Hannaford spokeswoman Anne Marie DeVie said the grapes were sold by Nobility Fruit fruit company. Hannaford was at least the second New England grocer to stop or limit grape sales because of the spiders. On Sunday, Stop and Shop stopped sales of red grapes from Coachella Valley at its stores in Massachusetts, Connecticut, and Rhode Island. Well, COMEX silver futures traded modestly higher today, with the most active September contract pushing firmly through the pivotal $4.53 mark, despite a disappointing close Tuesday when prices penetrated $4.50 to settle nearly 4 cents lower. Traders said they were impressed with silver's ability to bounce back. September was up 4.2 cents at $4.51.5 an ounce. COMEX gold futures wiped out yesterday's losses and gained over $2.50 an ounce in early trading on general dealer buying. An active August contract nudged past near-term resistance at $3.73 to top at $373.20, its most expensive price since June 18th. At that time, values peaked at $375. We're still in the same old trading range, said William O'Neill, senior futures strategist at Merrill Lynch. He said until we break out above or below that range, there is really not much this market can do. O'Neill pegged August gold's familiar span between $368 and $375. Well, the dollar opened higher against the mark after breaking through resistance at around 1.81 marks in overseas trading on sentiment that the Bundesbank will not raise German interest rates when it has its council meeting tomorrow. The dollar opened slightly lower against the yen, which strengthened on a recovery in Tokyo share prices. Well, that is the news we have for you on commodities this morning. The Dow Industrials are up 26 points. We have a special interview show coming up for you next, so stay with the Business Channel. Don't touch that channel changer. You never know where it's been.
The following is a paid commercial program with the guests paying a fee for their appearance. The Business Channel continues now with The Money Manager, brought to you by Payne Weber in the city of Brea. Now here is your host, Larry Smith.
Good morning. Welcome to The Money Manager. This is Larry Smith. Last week there was a great article in the LA Times talking about clients that have difficulty coming up with an investment strategy or following a philosophy of investment over a period of time. And I think we can particularly see that after times like this last quarter, when the market goes a little bit flat, a little bit sideways, a little bit down and up, and people start getting concerned about what they're reading in the newspapers and the economy, and they forget what their original plan of attack was or what they wanted to do originally. Today, again, on The Money Manager, we want to talk about the Payne Weber Access Program, which allows individuals or corporations with $100,000 or more to get the same kind of professional money management normally requiring in excess of several $1 million. My guest today is Mark Correnti of Nicholas Applegate Capital Management in San Diego. Mark, welcome to the show.
Good morning, Larry.
I think that following an investment strategy or a focus is one of the primary reasons that some people are profitable in the market and others are not. And one of the major benefits of the Payne Weber Access Program is that it gives an individual a questionnaire as a starting point to developing a written set of guidelines of what they want their investment program to be. That allows us to match up an individual custom portfolio with the style or philosophy of manager, after all there's 16,000 of them in the country, that they need, that they can get the kind of returns they're looking for and also sleep at night. Mark, can you tell us a little bit about Nicholas Applegate?
Yeah, we have a little bit different style and philosophy than others in your program. First of all, we take a bottoms-up orientation, which means we're looking at individual growth companies as opposed to looking at industries or sectors. Secondly, we place between 40 and 60 stocks in a portfolio. And finally, we remain fully invested to the extent that we can find profitable growth ideas in the marketplace.
Fully invested. Now, that's something that I think a lot of people really focus on right now. I see the Dow back up yesterday strong and up this morning, and I know I've gotten some calls from clients saying, gee, I think it might be time to get out a little bit. They're a little scared. They're reading some things in the newspaper. What do you feel about being fully invested at all times?
Yeah, we explain being fully invested as follows. There's a recent study by DataStream and Ibbotson that highlighted the 10-year period of the 1980s. And what they came up with is as follows, is that over 77% of the market's performance on average can be attributed to just 4 days a year.
So in 4 days a year, you're getting 70% of the move of the market, and if you miss that, you're missing 70% of the move.
That's right. We're not going to pretend to know when those 4 days are going to take place to gain that 77% on average.
That's phenomenal. Access has 16 different managers, access to maybe 600 that you can use that have different philosophies, and I think some of the philosophy that Nicholas Applegate follows is really rather interesting. Could you go into that a little bit?
Yeah, we're primarily, because we're a growth stock manager, we're looking primarily at small and medium cap stocks. We define small by less than 500 million in market cap, medium greater than 500 million in market cap. So we're looking at those companies that really have earnings rates greater than the S&P 500. These kinds of companies have gone through extended periods of outperformance of the market as well as underperformance of the market. And since 1983 through 1990, they really have underperformed. And now all the indications are that they're going to go through a period of outperformance starting in 1991 for the next 5 to 7 years.
I think that's an important distinction to make. We know that your record has been excellent in small and medium growth companies during a period of time that small and medium growth companies are considered to have really lagged the rest of the market. And you say that you believe that the 90s, the early 90s, could be excellent for small and medium growth companies. Can you tell us a little bit why?
Yeah, especially in light of our past performance. A couple of, you talked about our past performance doing well in a difficult environment. Pensions and Investment Age, which one of the leading institutional periodicals, came out with a study that said over the 10-year period of the 1980s, they came up with a top 7 managers, and we were very fortunate to be included in that group. In fact, if you read through that article, you'll find that we even headed up that list, and that's our small cap area. We've run the medium cap for 6.25 years, and since inception, we're in the top 1 percentile of all money managers. Now that, again, is during that difficult period of time since '83 and most of the '80s. There's now reasons why that there should be an extended period outperformance by these group of stocks, one of which is if you look at the growth rates, we're getting 5 times the growth rates in our portfolios. Is number one. Number two, because they've underperformed for the last 7 to 8 years, these stocks are really at all-time low in terms of growth companies, really at 10-year lows. So it's great growth, and the valuations are very compelling.
So we're at a time right now where people think the market is high, and the small and medium growth stocks are really at a low point and offer some opportunity.
That's exactly right.
We'll be right back. Stay with us.
You are watching The Money Manager, hosted by Larry Smith, an investment executive and certified financial planner from Payne-Weber in Brea. Larry specializes in a special program at Payne-Weber called Payne-Weber Access, which provides professionally managed portfolios for individuals and small corporations. Payne-Weber Access is the key to top-flight money management. For one all-inclusive annual fee, Access provides many important benefits. Access to outstanding professional managers with as little as $100,000. Identification and analysis of your investment objectives. A manager search process that performs rigorous due diligence to select top managers. Professional investment management of your individual portfolio. Freedom from paying commissions on every trade. Quarterly performance evaluation of your portfolio and manager relative to the S&P 500 and other market indices. For additional information on how the Payne-Weber Access program could apply to your portfolio, IRA rollover, trust, or corporate pension plan, call Larry Smith at 1-800-540-0033 or collect at 714-256-5400.
Welcome back to The Money Manager. This is Larry Smith. My guest is Mark Correnti of Nicholas Applegate Capital Management in San Diego. Mark, Nicholas Applegate manages $3.5 billion. Can you tell us a little bit about that?
Yes, it's $3.5 billion for institutions as well as high net worth individuals. Some of the institutions we're currently managing money for are Stanford University, Notre Dame, Yale Universities.
Big names.
Yes.
Absolutely. A lot of times I think our clients are a little confused about talking about a growth stock style. I know one of the things that I really try to stress in developing an investment philosophy is that growth stocks offer the greatest returns, but a value stock orientation can also flatten out the investor's return and a lot of their risk. And people say, well, gee, I'm in the market for growth, so I don't understand the value. Can you explain a little bit about what the definition of a growth stock is for viewers?
Well, the way we define growth stocks is we're looking for earnings rates greater than the market, those top earning, growing companies, as opposed to a value manager who's looking for undervalued assets. If he bought the stock today and sold off the company tomorrow, he would make money in a value approach. Where growth, you're paying up a little bit of a premium. What's important is you should have both styles in your portfolio. When a growth manager is doing well, typically a value manager is not. When a value manager is doing well, typically a growth manager is not. And by adding both together, you're getting greater diversification in stocks and you're getting better performance.
I think that's really true, and it's a very important point for people to consider in picking a manager. One of the real benefits of the Payne Weber Access program is with 16 to 20 different qualified managers in the program out of 700 that we're constantly screening. The ability that is there to find managers or a manager to manage your investment portfolio, custom tailored to what you're looking to get, and to maximize your returns from any market possibility, and also to reduce the volatility so that you can sleep comfortably. We talked a little bit about the wrap fee program, the annual fee, so that individuals with $100,000 or corporations with $100,000 in a pension plan can get the same kind of professional management, for example, of Nicholas Applegate, who has minimums of $5 and $10 million outside of a program like this. Normally, very large corporations and very wealthy individuals would be using them. But what would be the advantage of somebody to use a wrap fee program instead of a mutual fund, for example?
Yeah, we get asked this quite a bit. Mutual funds are fine for the people who have the ability to get into a mutual fund, but if you have the ability to get into a separate account, you owe it to yourself to do so. Really, you have greater access to the portfolio managers through a separate account. You have greater control in being able to tailor your portfolio. But more importantly, you have more control in the sense that there are not other investors with you in this pool. Now, I describe a particular situation